Bank of America Merrill Lynch just this week called rising oil prices an oil shock and scaled back its global GDP forecast for 2011 and for 2012. And while the firm's downward revisions were only by a tenth of a point globally, the same report also revised U.S. GDP for the year from 3.1% to 2.8%. Joining us to talk about this is Alberto Ades. He's Bank of America Merrill Lynch Global Emerging Markets economist. Alberto, good to have you here with Matt and myself.
Thank you.
So should we be worried about what we've seen in the trend in oil prices in terms of what it could do to slow down our recovery?
Well, we definitely should be worried. What we've seen so far is not enough to generate a global recession, and is not enough to generate a significant slowdown in emerging markets that are growing, as we know, very, very fast. Our forecast showed emerging markets prior to this crisis growing at about 6.5%, 6.6% for this year. So at current levels of oil prices, the shock is going to generate some slowdown, some upward pressures on inflation, and is going to put some pressures on central banks to hike more or to hike interest rates a little bit faster. But we should be worried, because the situation in the Middle East is no way resolved yet, as we are seeing in Saudi Arabia and in Libya.
Let me ask you, Alberto, the bank was leaning towards bumping up its global GDP estimate until this oil price increase. We do see oil, the price cooling off a little bit, as we just showed you there, about $102 and change a barrel for WTI here in New York. What's the level that tripped you up, that said, listen, we've got to cut this forecast instead of raising it? I mean, what are the levels that you're looking at, the key levels in oil?
We're looking at levels. What the research shows is that you really should get worried when oil prices rise above the highs over the past 3 years. The highs over the past 3 years were about $145 a barrel, so for WTI. So we think that level is a worrisome level. And if you look at our research, what we've said is the hike in oil prices that we've had is not enough to generate a recession, is not going to generate a significant slowdown. But we need to watch that 150 level, because at that 150 level, a global recession is a possibility. If we go even above that at 200, it's almost a certainty that you're going to get a recession at a global level.
You know, Alberto, I'm listening to you. I think if we get to 125, 130, psychologically, it could bring about a recession. I mean, how likely do you think it is that we start to hit these levels?
If you look at the research of our oil strategies, they actually, obviously, when you put a forecast, you have to say what's the most likely number that we're going to see printed on the screens. But there's many other scenarios, and we are assigning about 30% probability that oil is going to trade above 130, 135. So it's a 1 in 3 probability that we're going to see those levels of oil prices.
And obviously enough to make you nervous here.
No, yeah, definitely. I mean, roughly about what we found empirically is that about 10% increase in oil prices hits you by about 10 to 20 basis points, meaning a tenth to 2/10 in terms of growth. So if we get oil at 35, 40, we're going to get, 135, 140, we're going to get very close to the levels that we saw in 2008, and that's going to generate all types of concerns. In addition to that, as we know, we are having inflationary problems in the emerging markets. The emerging markets have been an engine of growth, and so if the combination of high food prices that we already have is complicated by rising oil prices at fairly high levels, that's going to put pressure on central banks in the emerging economies to slow down growth.
Let me just ask you, Alberto, if you take off your fixed income hat and put on your economist hat for emerging markets here, what do you see playing out in the Middle East? I mean, we have had disturbing reports of Saudi Arabian police firing into crowds. Obviously, things are not calming down in Libya. Does it spread? Do the problems spread beyond Libya? Do we start to seriously worry about the kingdom here?
Yes. I mean, we are definitely concerned. We're watching the situation very closely in Saudi Arabia, in Algeria, in Bahrain. It's a very problematic situation. If you look at our oil price forecast for 2011, we were looking at oil prices peaking in the second quarter and then normalizing as the situation in Libya normalizes. But the most recent developments suggest that the situation in Libya, the civil war and the conflict can extend beyond what we're anticipating. It's not necessarily going to imply higher prices only from Libya, but it may imply higher prices for longer than we are anticipating.
All right, Alberto, thanks so much for joining us. Alberto Ades there. He is the co-head of Global Emerging Markets Fixed Income Strategy at Bank of America Merrill Lynch.